Hi. So today what I'd like to talk to you about is break even, right? A break even analysis. And basically what a break even is what point do we break even? When do our costs are covered by our revenues, by our sales, right? So we're going to look at this graphically, and what it does is it highlights the relationship between price and volume, which is revenue, right? That's our sales too. We could call this sales or revenue. And then our costs. And our costs are our fixed costs and our variable costs. So now let's get to it here. We're going to make a graph, right? I'm going to show you on the graph because this is going to be intuitive at first, and then I'll show you a formula for calculating the break-even point. But first, let's talk about it graphically so we can gain some intuition on how these things operate. So on the vertical axis, we're going to put money, and on the horizontal axis, quantity, right? The first thing we're going to do is put in our fixed costs. And fixed costs are the costs that don't change no matter if we sell 0 products or we sell 1,000,000 products or whatever. The amount is just fixed. It's the amount for, say, the machinery, the factory. Say in the case of a pizza parlor, it would be the oven to cook it, and the rent for the restaurant space. All those kind of things are fixed. They don't change no matter what the volume of our sales are. So let's put a line that just goes straight across, right? That means that the fixed costs are the same no matter what the quantity is, right? And we'll call that our fixed costs. The next thing we want to look at is our variable costs. And our variable costs are the costs of what goes into each item, right? And so with a pizza, say, it would be the dough and the sauce and the cheese, the different items that actually go into each individual unit that we sell. And so those costs increase as the quantity that we sell, right? So we start out here and it goes up, and that is our variable costs, right? So you can see I'm starting it on top of the fixed cost because the fixed costs we have to pay no matter what. And then we have to cover our variable costs. So obviously the most intuitive part of business is to sell something for a price that's more than it costs you to make it, right? That's all we're trying to do in business, basically, is trying to sell something for more than it costs us to make it, and that difference is our profit, right? So let's take a look at our pricing now, right? So as our pricing with quantity, the slope of this line will be the price per unit, right? And so let's say we've picked our price, and we're going to look at several prices to see maybe even, but we could pick a price, and that price, as we go up, crosses over this point at some point of our costs. And that point is the break-even point. That is where we are covering our fixed and variable costs with the money from our revenues, from our sales, right? So this is a revenue line. It's this line here. It's our sales, the price per unit, and as we sell more units, we go up that line, right? And at the point where they cross, that's the break-even point. And that is what we're looking at. So now we can see conceptually how all of these different, the dynamics of all these different parts of our sales equation come together, of our business equation. And so this part here, after we do the break even, right, between the variable costs and the revenue, this is what? This is our profit or our net income. Remember, those two words are synonymous, right? They mean the same thing. And that's basically just our revenue minus expenses equals net income, right? That is an income statement. That's the basics of an income statement. So that's what we're seeing there. So see how all these things are shown on this graph. So now let's look at the formula. How do we actually find how many units, right? How many units, what's the quantity, and it's going to be in units, do we have to sell to break even? So the equation for that is what we're looking at is how much can we contribute to our costs from our sales. Let me just grab this here for a second, and I have some notes here I'll talk off of. So basically what we're looking at is the price, right? Our price minus our variable costs, right? That is called the contribution margin. We call that the contribution margin. Contribution margin. That's how much we can contribute per unit to our costs, right? Take the variable costs away, and then from the price, and then the rest can be contributed towards covering our fixed costs, right? So now what we're going to look at, and so then we take our fixed costs, right? And because we're looking at how many we can contribute to that, right? And our fixed costs, we're going to divide our contribution margin by our fixed costs, and that is going to give us our break-even units. So here's the formula for it. Our break-even units equal our fixed costs divided by the difference between our price and our variable costs. And now I'm going to give you a little quiz, and here it is. So say that our price is $50 and that our variable costs per unit are $10, whatever the currency you're working in, and then our fixed costs are going to be 10,000. So what I'd like you to do now is take these numbers, plug them into this formula, and come up with the answer. I want you to come up with this answer here. So pause this video right here and do that calculation. Shouldn't take you but a minute, right? And then I'm going to give you the answer. But pause it so you don't listen to the answer and try to work this through. Okay, so I hope you got your answer. And now let's take a look at how we would set this up as a formula. So the price is 50 and the variable costs are 10, right? So that equals 40. So it's going to be a 40 in the denominator, right? And then we have 10,000 in the top here, right? 10,000. And so what does that mean for how many units we have to sell? Well, you divide 10,000 by 40 and you come up with 250. So that we'd need 250 units to sell to break even. So I hope this has given you an idea and tied together these concepts so you can actually see how they dynamically relate. If we raised our price, say if we raised our price, then we would have a steeper curve, right? Well, what would we do? We'd reach break even earlier, right? If we lowered our price, our break even would be maybe out here or something. So we can see how these different things, if our variable costs go up, then we have to go out, if our, out further to break even. If our fixed costs increase, we have to go out further. If our fixed costs decrease, we could bring that break even into less units. So these are the kind of things to think about when you're deciding on, once you know what your costs are, on what you should price your product or service at. So hope that was good, and I'll catch you in the next lecture.